big gap, obviously because of the Russian invasion of Ukraine. But whenever you have a big gap, you're far, far below the average price, and the market often will snap back. In other words, you can get a trend from the open up. Sometimes you'll get a trend from the open down when you have a huge gap. Most often, what happens is the market gaps down to what traders think is a fair price, and then it goes sideways for an hour or two, and then decides on the direction. The moving average is based on 20 bars. If this goes sideways for 15 or 20 bars, the average will be down here, and the market will then be at the average price. Traders will decide if it's going to continue down or reverse up. Here, when there's a big gap down, when there's any gap down, this is what I want. Yeah, whenever there's a gap down, 80% of the time, the market's going to have some kind of trading range open. The bears will look for a double top or a wedge top near the moving average, and then a trend down. And the bulls will try to get a double bottom or a wedge bottom, and then a trend up. And it takes an hour or two to create a double top or a wedge. The bears are hoping we're going to get a bear trend from the open, right? And the bulls are hoping we're going to get a bull trend from the open, a market that just rallies up. If we get a bunch of early bull bars, the odds of a bull trend will go up. If we get a bunch of early bear bars, the odds of a bear trend from the open will go down. But most of the time, we're going to get confusion. Globex low, the bulls have a double bottom and a double bottom pullback. We should break out of the Globex low or the Globex high. If we break above the Globex high, we'll close the gap below yesterday's low. So the bulls are hoping we're going to quickly go up. The bars are huge, right? So if you trade, you have to trade small. You know, this is already a 15-point bar just 2 minutes into the bar. The more it closes on its high, the more bulls will buy with the stop above its high. Some bulls will wait to see if we get 2 bull bars. Remember, what's most likely is the market's going to go sideways. You know, in other words, up for 2 or 3 legs, and then once it gets to the moving average, the market traders decide, will it keep going up or will it reverse down? Again, the more this closes on its high, the more likely it'll be the low of the day, and the more bulls will buy with the stop at the high of the bar or buy at the market. But you have to trade small. It's already a 20-point tall bar. That's $1,000 per E-mini contract. If it pulls back and has a fairly conspicuous tail on top, a lot of bulls will wait to see if we get 2 consecutive bull bars and then buy. And can you sell the close? No, you cannot sell the close. You don't want to be selling far below the average price unless you're selling bars that are far above average bearishness. And if you have a bull bar, especially a big bull bar closing near its high, that's not bearish at all. And you should not be selling that far below the average price. So the question here is going to be, will the bar close near its high and be the start of a bull trend from the open? Or will it have a conspicuous tail on top, generate confusion, and then the market goes sideways for 20 bars until the average gets down here? You can see the average is falling quickly. It's based on 20 bars. Every bar here, excuse me, this is what I was talking about in terms of a conspicuous tail. The bulls want evidence of relentless buying. They want the market to not have pullbacks like this. That tail on top is hesitation, and it reduces the number of bulls willing to buy the market. Now, nobody's going to sell bar 2. And why is that? Because we're far below the average price, and we have a big bull bar, bar 1. So nobody's going to sell 2. But if we get two big bear bars, 2 and 3, traders will sell even though it's far below the average price. But most likely we're going to be mostly sideways to up for the first hour or two. And if it's more sideways, traders will be less willing to buy with stop orders above things, and they'll be more likely to buy with limit orders below things, especially below bull bars. Bulls are disappointed by the tail on 1, but they're still looking at this saying, wow, we're far below average. You know, chances are we're going to go sideways or up. So traders are looking to buy, but a lot of traders will want at least one bull bar closing near its high and having a big body. And they prefer to have consecutive bull bars where one of them is a big bar and closes near its high. Bar 1 is a big bar but did not close near its high. So the bulls will try to get 2 to close near its high. And then they'll either buy the close or buy above it. Trading range open is likely. And trading range can be a tight trading range where we just go sideways, or it can be a couple legs up, a couple legs down, 2 or 3 legs up, 2 or 3 legs down. All right, here's the trading range. We sold off for 3 legs, 1 pause, 2 pause, 3. We rallied for 3 legs, and then down again and up again. So that's the trading range. But there was a double top, and bears will sell a double top near the moving average. Here we had a very strong rally, a second strong rally, but there were 3 highs, 1, 2, 3. That's a wedge, and it's at the moving average. There was a smaller wedge here. Traders would sell that. It failed. We got a breakout above the wedge and a second reversal, and they'll sell that again. A reversal down from the moving average and a wedge. Bears are hoping if we get bull bars that we quickly reverse and get a swing down. Another thing about trading range opens, they reduce the chance of a big trend. If you have a couple hours of sideways trading, that means the price is just about right. And if you do get a trend out of it, it's usually not a strong trend. Sometimes you'll get a strong trend. More likely you'll get a swing down or up for 2 or 3 hours, and here a reversal, here a trading range. So the more trading range trading you get early on, the less likely you're going to get a strong trend. And by a strong trend, let's talk about the bull case. This is what the bulls want, a gap down and just a series of bull bars with only brief pullbacks, 1 bar, small pullbacks. Okay. 20% of the time, when you have a big gap up or down, you're going to get a trend from the open in either direction. So what about the concern over Russia and the Ukraine? Everybody already knows that, right? And this is what the market's doing despite that. We got the big gap down, but the bulls are trying to get a bull trend from the open. You also have traders who, investors who look for any big sell-off to buy. Okay, so let me just stop and say, if you do buy this, and it's reasonable to buy it, if you do buy it, you have to be trading small because your risk is big. But what I was just saying a moment ago, there are a lot of investors, institutions, individuals who invest for the long term, and they keep accumulating cash from whatever reason, right? You know, if you're a person, you're working, you're generating money, you have savings, and you want to buy stocks, a lot of traders will wait for the market to fall a certain percentage, 2%, 5%, 10%, 20%, 30%. And when it gets around those numbers, they'll buy. And that's why corrections often end almost exactly at 10% or 20%, because there are a whole bunch of institutions who are looking to buy a 10% correction, a 20% correction. So this is a buy above 2, stop below 1. So anybody taking the buy has to be trading very small. Bulls are hoping we're going to get a bull trend from the open. Bears are hoping this is a bull trap and that we begin a bear trend from the open. But it's unlikely we're going to get a strong bear trend today. We have a big gap down. That increases the chances of a trend. It increases, and a bear trend is more likely than a bull trend. Just as soon as the market opens, we know that, right? But when you have two big bull bars on the open, that reduces the chances that today's going to be a big bear trend day. Because nobody's going to want to sell below 3 or below the average price after two big bull bars. And if nobody wants to sell, we'll probably have to go sideways for an hour or two and create a double top or a wedge top, and then bears will sell. But if the market's sideways to up for a couple hours, that means the market thinks this price is just about right. That reduces the chances of a big bear trend. So right now we already know today's probably not going to be a big bear trend day. 80% chance we're in a trading range. 20% chance we're in a trend from the open. And if it is a trend from the open, up right now is more likely than down. What happens if we get 2 or 3 big bear bars closing below 1? Then it could be a bear trend from the open. But typically, if you're going to get a bear trend from the open, you're not going to start the day with 2 big bull bars. Are these bars big? Compare them to the bars yesterday. Right? These bars are huge. They're much, much bigger than yesterday's bars. So these are very big bars. Bears want a bear trend from the open. Let's take a look at some examples of bear trends from the open. Okay? Bear trend all day long. Gap down, bear trend. Gap down, bear trend. But what do you notice? Do you see 2 big bull bars on the open? Do you see 2 big bull bars on the open? Do you see 2 big bull bars on the open? Do you see 2 big bull bars on the open? Right? Here we did have 2 big bull bars in the open, right? And then a bear trend. But that's the exception. Most of the time, here we got 2 big bull bars and a bear trend. The bulls tried to get a wedge bottom. It failed, and we sold off all day. But most of the time, if you're going to get a really big bear trend, you're not going to begin with 2 big bear bars. Most of the big bear trends begin with bear bars. I showed 2 examples out of 10 where there were 2 bull bars on the open and then a bear trend. So chances are this is not going to be a bear trend from the open. I did have a stop order to buy above 2, and I just canceled it. Remember, chances are we're going to have a trading range open. Trading range open means 2 or more reversals. So the market can go up, reverse down a couple times, get 2 or 3 legs down, reverse up. But that's what's most likely, some kind of a trading range open until we get closer to the moving average. Once we've had about 15 bars, even if there's a big gap down, most of the average will be calculated. The average is calculated by 20 bars. If 15 of the 20 bars are down here, the average is going to be down here. And then once the average gets down to today's prices, then traders will see how the market behaves around the average. Will it break strongly above the average and create a bull trend? Will it reverse down from the average and create a bear trend? If you do have a trading range open and you get a trend, usually the trend will not last all day. If you spend 20 or 30 bars sideways, there are only 50 bars left, and usually you'll trend for 2 or 3 hours, but not all day. So trading range open, we sold off and we rallied. Trading range open, here a wedge rally, we sold off, we rallied. A double bottom, we reversed up strongly, but then went mostly sideways. All right, so it's still a buy above 2, but the buy signal bar is 3. A high 1 buy, and what the bulls hope will be a bull trend from the open, and bulls will be hesitant to buy above a big bear bar. You could buy above 3, you could buy above 2, but it's going to reduce that big bear bar plus the tail on the top of 1, both reduce the number of traders willing to buy above 3. Now for the bears, they're hoping that this is a buy climax and a bear trend from the open. But as I showed you, when the market's far below the average price, if you get 2 bull bars, most of the time you're not going to get a bear trend from the open. This is what the bears want. If they get a bear bar closing there as low, bears will start to sell. If we get 2 bear bars, you'll get more bears selling below the low of the bar. And if you get 3 bear bars, we're probably going to get a swing down. 3 bear bars and a close below. So the bears want this. And even with that, look at what the trend was. A lot of reversals. It's basically a tight trading range sloping down. So difficult to trade with stop orders. If you sell below that, what do? You put your stop up here. You get disappointing follow through. A lot of bears will get out above any bar. You get a big bull bar, a bear bar closing below its midpoint. This is really difficult for stop entry traders. But you got to trade the day you have, and if we get a day like that, that's what we got to trade. So you trade smaller, and you patiently wait or use wide stops. Why would the market go up after Russia invaded Ukraine? Because the market over the past few weeks has been selling off, thinking Russia was going to invade Ukraine. So it's already priced in the invasion. What we don't know is whether it has priced in the invasion adequately. Is this the right level after an invasion, or should the market, should the price be lower? What's going to happen? Are they going to try to take over all of Ukraine? And the market therefore would sell off more, or are they just going to try to break off 2 provinces and not invade and not try to take over the country? So that's the buy, a high 1 buy, but a bear bar. You could buy above 2, a bull bar, but it's disappointing. 3 is a disappointing bar that will reduce the number of bulls buying above 2, above 3. It increases the chances of a trading range, and when the market's in a trading range, traders are less willing to buy at the high. Now, the bears wanted a bear trend from the open. They wanted 3 to be a low 1 sell signal bar. And what happened with 4? 4 did not go below 3. Now, if the bears are going to get a bear trend from the open, they certainly should be able to get a bar to go below a bear bar. And 4 did not go below 3. And why was that? Because bulls knew it would increase the bearishness. So the bulls had limit orders to buy at the 3 low and just above the 3 low. And there were more dollars trying to buy at the 3 low than there were dollars looking to sell. And 4 could not trigger the sell signal. Instead, it triggered the buy signal above 2. You can see we're getting very close to the moving average quickly, because every bar here replaces a very high price bar, and that brings the average down. The more bull bars we get, and the bigger the move up, the less likely we'll get a big bear trend. So even if we do get a bear trend, these 3 big bull bars reduce the odds of a very big bear trend. Big bull bar 4, but will 5 be a bear bar? 2 closed on its high, but disappointing follow through 3. 4 closed near its high. The bulls want anything other than a bear bar, and they do not want a big bear bar. If they get even a perfect doji, it increases the chances that will continue higher. Maybe a measured move up. We have right now a gap, 5 low, 2 high. So it could lead to a measured move up. That would get us up there. That's a 50% retracement of that. And you can see 3 and 4 bulls bought a 50% pullback. So you have bulls willing to buy with limit orders, but there's some hesitation for stop order bulls above 1 and so far above 4. Is it still likely that we're going to have a trading range open? Yeah, but the more bull bars we get, the more likely we've seen the low of the day. And if we start to get 2 or 3 consecutive bull bars, especially bars closing near their highs, it would increase the chances that this will continue up as a bull trend from the open. Two legs up, 2, 4. It's a higher high double top, 5, 2. But it's also a 5-bar bull microchannel, no pullback for 5 bars. That will reduce the number of bears willing to sell. All right, so that looks insignificant, but it's important. The bull's unable to get a bull follow-through bar, so it increases the chances of a wedge rally. Right now we have a higher high double top, 2, 5. You'll have disappointed bulls selling out of longs below 5, but not many bears. They want a stronger bear bar, plus they would like a low 2, or never triggered the sell below 3. And that meant the bears were not strong enough to sell below 3, and that will reduce the number of sellers here. Now, who's causing the selling here? Probably mostly bulls. How do I know that? Because the bears don't want to sell these bars, right? It's a bad sell signal bar after 3 big bull bars and a 5-bar bull microchannel. So the bears are not selling. So the people who are selling are bulls who are hoping that the market was going to race up, that other bulls would buy. And the market went up and bulls stopped buying. So the bulls who are long are starting to scalp out. So this is mostly bulls exiting. So some of the bulls who sold here were scalping out with 10 points profit, and the bulls selling here are trying to sell out without a loss. So they're trying to get out around break even. Might get one more push up to a wedge, 1 pullback, 2 pause, and then 3. Difficult to trade. If you bought above 4, what are you thinking right now? You're thinking, 5 is, I didn't want 5, I wanted a second big bull bar. So a lot of the bulls who bought the 4 close or above 4 have limit orders to get out break even after seeing 5 disappointed bulls. And you can look at the high of 6. It's right around the high of 4. That tells you that a lot of the bulls who bought 4, disappointed 5, placed limit orders to get out break even around the 4 close and the 4 high. Chances are we're going to go up with one more leg. It's still a bull trend from the open, and it could be a small pullback bull trend. 6 could be simply a small pullback in the trend that just goes up all day. That's why bulls are willing to buy. They're taking a chance. We're going to keep getting body gaps. Right now, we have a gap between the breakout point, the 2 high, and the pullback, the 6 low, or at least the body gap. These bodies, the pullback bars, do not overlap the breakout point. So that's still consistent with a measured move up. Weekly chart. Different channels. We broke below this channel. I'll get rid of that. And then if you create a parallel to that, you get this. We broke below that, tried to reverse up. If you create a second parallel and anchor it here, then you have a possible bottom of a channel here. Daily chart, bulls are hoping. It's just two big legs down. One pullback, two. Remember, I said I've been saying all, since the end of January, since we went below the December low, I've been saying we're going below the January low. And I said we would do it in February or March, and we did it in February. Even when we had this strong rally, I still said, despite the strong rally, we still should go below the January low to see what's there, buyers or sellers. Head and shoulders top, left shoulder, head, right shoulder, and we're breaking below it. But only 40% of head and shoulders tops result in a swing down to a round or measured move. 60% do not. And the bulls are hoping that we're going to reverse up quickly and that this will be the end of the sell-off. So high 1-6, but possible parabolic wedge. So if you buy above 6, you got to make quick decisions because it's a possible parabolic wedge. 3 legs up, 1, 2, and then 3. Bears selling, just like the bulls bought around the low of 3, because that would make things bearish. Bears are selling the close of 6. They're trying to prevent the high 1 buy from triggering. The high 1 buy probably will trigger, but it's a third leg up. That will reduce the number of traders willing to buy it because traders are afraid of a parabolic wedge rally. Gap down, 3 legs up. Okay, we had 3 highs, 1 down, 2, and then 3. So a third leg up or a third high. Same thing here, 3 legs up, 1, 2, 3. Traders are hesitant to buy the high 1 after the second leg up because the market often gets profit taking on the third leg up. A lot of times parabolic wedges don't look like wedges, but if you can envision 3 highs, you might have a parabolic wedge. Big gap down. So 1, 2, 3. Here we got a fourth leg up, and then profit takers. 1, pause, 2, pause, and went a little bit higher, and then down. Gap down, big gap down, got to the moving average, and different ways to look at this as a wedge. Bulls took profits, bears sold. This is in the wrong section. Now, what's going on here? It's a micro double top. Up on 5, down on 5, up on 6, down on 7. The neckline of the micro double top is the 6th low. So it's theoretically a reasonable short below 6. But we have 4 big bull bars closing near their highs. That will reduce the number of stop order traders selling below a bull bar. So are you feeling confused? Do you feel like this is clearly a bull trend? Do you feel like this is clearly the start of a bear trend? Well, neither. That means you feel confused. Confusion is your radar telling you the market's probably forming a trading range. So don't get upset by it. All right? Don't say, oh my gosh, I went up on 2 and down on 3 and then up on 4 and down on 5, up on 6, down on 7. No, it's taking my money. No, it's just telling you that look at it as your radar telling you that this is probably a trading range open, which I said was likely right on the first bar, right? So this is just doing what the market typically does when there's a big gap. In fact, most days, even without a gap, have a trading range open. Only 20% of the time do you get a bull trend or a bear trend right from the open. Normally, there'll be at least a couple reversals. Now, if you're a bear and you sell below 6, are you looking for a bear trend? No, because you got 4 big bull bars, and there's still room to the moving average, which is a magnet. So it's probably mostly bulls selling out of longs here than bears selling into shorts, because it's not a very good short. Too many big bull bars, and therefore it's probably not going to fall all that far. And if it's not going to fall that far, the bears will be scalping. Now, some bulls did not buy the 6 close, but they want to buy. If it's trading range open, traders want to buy low and sell high. So bulls looking to buy, we're not willing to buy above 4 or 6, but they do want to buy. So they'll buy with limit orders below a bull bar 6 or a 50% retracement, which is right around here, or maybe a test of the 3 low. So if it's not going to be a bear trend from the open, and if this is a bear leg in what will be a trading range, everybody knows that. The bears know it, so they're going to take quick profits, 5 or 10 points. The bulls know that, so they'll buy 10 points, 20 points below something, below 5, below 6. They'll buy at prior lows, the 3 low. But you can only do it if you can trade small and use wide stops. And most individual traders, especially traders starting out, should not trade that way. They should be looking for stop entries. So here we have a good bull bar 4, and they sold above it. Here we have a big bear bar closing nearest low, and they bought below it. Right? It's the opposite of what makes sense, and therefore is consistent with what I'm saying, a trading range. When it goes down, traders buy. When it looks bearish, traders buy. When it goes up, traders sell. When it looks bullish, traders sell. They bet against follow through. They bet on reversals. I want to go back to the Globex chart. 90% of the time, we either go above the Globex high or below the Globex low. And today, the Globex high is extra important because we have a big gap down on the daily chart, and the bears are hoping it's a measuring gap and that we get a measure move down, either based upon the height of that or based upon the height of this. They therefore do not want the gap to close. They do not want today to get above yesterday's low, and yesterday's low is right around the Globex high. So the bears do not want today to go above that Globex high, because that would close the gap on the daily chart and greatly reduce the chances of the market going a lot lower. I've been saying that we'd get below the January low, and I thought we probably would dip below 4,000. I still think that's true. Monthly chart, we're right near the 20-month moving average. We have not touched it in a long time. So there will be buyers around the 20-bar moving average, 20-month moving average. Then we have this gap over here. Last April, gap above March. Does not look like a gap, but there is a gap there. And it's right below 4,000. So we have the 4,000 big round number. We have a gap in the 20-month moving average, all in that general area. That's why I say I think we're going below 4,000. Some traders think we might get all the way down to the pre-pandemic high. And we might. If Russia tries to take over all of Ukraine, we'll get down there. But I suspect Russia is just going to try to carve out a big chunk of Ukraine this time around. All right, so a high one, but the body gap is closed. This body overlaps these bodies. And in the best small pullback bull trends, you don't close gaps and you don't close body gaps. So yeah, it's a buy, but it's not nearly as strong as it could be. Will bears sell the high, bears are going to sell anything bullish, bulls are going to buy anything bearish. But a lot of it is limit order trading. I think we're probably always in long since 2, and I think you can buy above 8, but the math is difficult. We have a trading range open, and there probably will be sellers not too far above 5. So if you take the buy, you've got to be trading very, very small. If it continues up as a bull trend from the open, and you trade very small, let's say you normally trade 1 E-mini, and now you buy 1 micro E-mini or 2 micro E-minis, right? And it keeps going up. You can buy more higher and eventually get back to a full-size position. But when the bars are really big like this, and when the probability is not as high as you want, it's better to trade very small. Now, will the bulls scalp out with 5 or 10 points? I think a lot of the bulls will take at least partial profits at 5 or 10 points. I'm going to put this back to a 15-minute chart. Traders trading multiple contracts, I think it's good to take partial profits at 10 points maybe. Bears want a double top 6, so 6 is a lower high. They want a double top 6, a break below the neckline 8, and a move down below the low of the day and below the Globex low. And the bulls are hoping that this is a bull trend from the open, and that we're going to go up to yesterday's low. What do I think is more likely? Will we go below the Globex low or above the Globex high? Right now, even with all these bull bars, I think it's more likely we're going to go below the Globex low, which means below the low of the day. The market often rallies about halfway to a target. So here's the Globex low, and here's the low of the day, and this is yesterday's low, and we're right around 50%. Bulls have about 10 points here, right? So reasonable to take partial profits. Also, if it's going to be a trading range open, remember I said bears are looking to sell above things. So that means you have limit order bears selling the 5 high, and the bears know bulls will take profits at 10 points, 20 points, and the bears will sell 10 points above 8, 20 points above 8. I did buy above 8, and I did take part off at around 10 points. I don't know if it was exactly 10 points. I just hit sell the market when I get up to around 10 points. Big bull bar, consecutive bull bars closing near their highs. Look at the bars today. How many bull bars do we have with big bodies? 6. How many bull bars do we have closing near their highs? 5. What are the chances that today is going to be a big bear trend day? Small. So if we do go down to the Globex low, it's probably not going to lead to a big trend, a big bear trend. Right now, we're still always in long since the close of 2. And it looks like we're going to reach the moving average within the next few bars. Now, why would we ever rally when Russia is invading Ukraine? Because the market is oversold, and a whole bunch of bulls were waiting for a big sell-off to buy. So you get bulls taking a chance that this is a great buying opportunity. I have a friend, college roommate, who I'm not going to give you his name. I never thought he was very bright, and he went to an average law school, and he was a lawyer all his life, and he's kind of a Forrest Gump type of guy, and all his life, he just put all of his money in the stock market, and he's done this now for 40 years, And anytime the market falls 10%, he buys more. He doesn't even try to buy 20%, 30%. As soon as it buys 10%, falls 10%, he takes all of his remaining cash and buys stock. And he stays fully invested the entire time. And right now, he's an extremely rich guy after doing this for 40 years. If you think about it, here's the monthly chart of the cash index. And 40 years ago, it was back here. Okay? So the cash index was, back when he and I were in college, it was back here. So the cash index was under 100, right? And now it's 40 times higher, right? So every dollar that he put in back here is now $40. Every thousand he put in is now $40,000. And he's been doing that all the time. Here we sold about 50%, we sold about 50%. He bought more, 10% down. He bought more, 10% down. Even though it ended up falling 56%, right? A couple of years later, it was back to his price, and now is many times greater than his price. So if you're a young person with cash, it's wise to put as much of it into the stock market as you can, especially when the market is down 10 or 20%. And don't mess with it, right? You just buy and hold. And it's fun to be a stock picker. Oh, I bought Apple, or I bought Google, right? But you don't have to do that. You just buy a SPDR ETF or a QQQ ETF, and don't think about it. Just buy and hold. And sometimes the market will go sideways for 10 years. It doesn't matter. Eventually, within 10 years, it's going to be higher, and it will soon be much higher. It's becoming increasingly likely that we're going to close the gap. 3 consecutive bull bars closing on their highs. Traders are buying. So traders are becoming less worried about the Ukraine and more confident that it's not going to be the disaster that everyone was afraid it might become. It looks like traders are saying, yeah, it's bad, but it's going to be contained in Ukraine, and it's probably not going to be all of Ukraine. So it's basically, who cares? Screw the Ukrainians. That's basically what the market is saying. Trading range for 8 months or so. We're trying to get a bear breakout, and the bulls are trying to make the breakout fail. The bull breakout up here failed, and now we're getting a bear breakout. You can look at it as a wedge, 1, 2, 3, or as a high 2, 2 legs down, 1 pullback 2. But very good for the bulls, right? This is very good. Getting near the end of the first hour, the bulls would like the hour to close on its high. Very, very oversold. I could draw a line along these lows, and we got a breakout far below the bear channel, and the breakout is failing. The bulls are hoping we snap back violently and begin a big bull trend. Bears are hoping it's a pullback, that the gap remains open, and that we resume down. "60-minute bar," we're getting near the end of the first hour. And whenever a 60-minute bar, especially the first one of the day, is very bullish, you tend to get some profit taking at the end of the hour, bar 11, bar 12. Now, I said the bears would try to get a double top or a wedge top at the moving average. Look where we are. We're at the moving average. We have 3 legs up, 1 pullback, 2 pullback, 3. So it's a possible wedge top, possible high of the day. Bulls know that. If you're still long, I would get out below a bear bar closing below its midpoint. I'd get out 5 or 10 points below a bull bar, bar 10, if this goes big outside down. And for the bears, some will short a wedge rally to the moving average. Others will wait to see if we get consecutive bear bars, especially after 3 big bull bars like this. So, yes, get out of longs below a decent bear bar, but fewer traders will be willing to sell below 11. It's a possible high of the day, so the math works out. Yeah, it's 20 points tall, so you have to trade small. But the bears selling are betting we're going to go below the Globex low. So they're betting we're going to go down 60 points. So they're risking 20 to make 60. You only have to be right 30% of the time for that to be a good strategy. So it's a reasonable strategy. Higher probability, if you want higher probability, you wait to see if we get a micro double top, or you wait for 2 bear bars or 3 bear bars. Bears are trying to close the gap. I talked about a body gap here, but the body of 7 overlapped the body of 2, and that closed the gap. We currently have a breakout point 6, that's the highest body, and then we have a breakout, and the bears are trying to get that gap to close. They want the 11 low to go below the 5 high. That would close the gap. It looks like it's probably already closed. And additionally, they want the bodies to overlap. So they want the body of 12 or 13 to overlap the body of 6. Tail on the bottom of 11. Reasonable for bulls to get out. Possible parabolic wedge to the moving average. But a tail after 3 big bull bars, you'll get fewer bears willing to sell. So yeah, it's bearish enough for bulls to exit. They don't have to. They can keep a stop below 8, but it's not bearish enough to attract a lot of bears selling. Because it's not a strong sell setup, you'll get bears, they sell hoping for a collapse. When it does not collapse, they decide to scalp out part, maybe 5 points, 10 points. And therefore, there may be buyers about 10 points below 11. And the bulls know that. So yeah, bulls will get out below 11. If 12 does not collapse, bulls will start to buy again, maybe 10 points below 11, maybe 20 points below 11. Or they'll wait for a high 1, 12, 13. Body gap. All right, I'll put a line there. I'm snapping this to the close of this. That's the top of the body of the breakout point. Here's a breakout. It broke out of something. It broke out of that. The highest body is that. So the bears are trying to close the body gap. Remember I said small pullback bull trends that last all day tend to have gaps and body gaps. And they tend to get at least a couple early in the day. We had a body gap, 6 low, 2 high, and that body gap closed. The body of 7 overlapped the body of 2. And now the same thing here. I put this line here because smart people know about body gaps. You know, I'm the only person I've ever heard use that expression, but the reason I use it is because a lot of institutions trade line charts. And on a line chart, you can see the gaps. You can see this low overlapped that high, so no more gap. And right now the market's deciding, are we going to get a gap here? Is this low going to overlap that high? That is a weaker bull trend. So, you know, the computers trading line charts see this gap as possibly closing, just like this gap closed. If gaps close, the trend is weaker, less likely to last all day. And I can see the body gap right here. So I can see what a line chart looks like. This is the end of the hour. Remember, the market often pulls back into the end of the hour, altering the appearance of the first 60-minute bar. 10 minutes ago, this was a big bull bar closing near its high, and more traders would be willing to buy above the high of the bar. Currently, it has a big tail on top. Fewer traders are willing to buy with a stop above the high of that bar, because when we were at that price earlier, 10 minutes ago, we sold off. Consecutive bear bars, possible high of the day. Okay, swing short. For the bulls, a high one, but two bear bars at the moving average and a wedge top. I'm going to get rid of the line. The body gap closed. All right. So even though we rallied strongly, body gaps are closing. This is the second time today they closed. That happens more often in trading ranges and bear trends, and less often in bull trends. So it's less likely that this is going to continue up as a big bull trend day. An hour ago, I said the market would try to get to the moving average with either a wedge rally or a double top. And the bears would try to get a reversal and a swing down, even with good bull bars. So the bears are hoping that we're going to get a new low. Bulls are hoping the small pullback bull trend continues all day. And we have a 3-bar pullback here, a 2-bar pullback here, and relatively small. And the bulls are hoping we just keep channeling up. Every time there's a bull bar closing near its high, 2, 4, 8, 9, 10, bulls will buy. What happens if 13 is a bull body, but a fairly conspicuous tail on top? It will reduce the number of bulls willing to buy. We've reversed down at the moving average, 11, and with 2 bear bars. So there might be more sellers than buyers above 12. It's a high one and a small pullback bull trend, but it's a bear bar. There are 2 bear bars, and we're right below the target, the average price. So I'm not going to buy above 12 or 13. I'm willing to buy again, but I'll wait to see if we break strongly above the average price, or wait for the market to pull back and form a double bottom, maybe 8, maybe around 1. Tail, 2 bear bars, that's not going to attract a lot of buyers. We have a wedge. Traders look for a couple legs sideways to down, but sometimes it's just sideways. Yesterday, a climactic sell-off, 2 reversals up. You'd expect a couple legs sideways to up, and sometimes it's sideways. First leg up and second leg sideways. We had a third leg sideways, and it was a triangle. Traders will sell, look for a bear bar closing near its low to sell, expecting at least a small resumption of the bear trend. So yesterday, sell climax, expect a couple legs up after 2 attempts up. So 1, pull back 2. Sometimes it's sideways instead of up. And here, traders expect a couple legs sideways to down. It could be just sideways. So 1, pull back 2. Bears are hoping that this is a failed breakout and that we'll get below the Globex low. Remember I said 90% chance we either go above the Globex high or below the Globex low. And the bears are going to try to keep the gap below yesterday's low open. And that I think makes it more likely we'll go below the Goldbeck's low than above the Goldbeck's high, especially since the body gaps are closing. 7 overlaps 2, 12 overlaps 6. The strongest bull trends, the body gaps stay open, and the body gaps here are not staying open, so something's wrong. It's not as bullish as it could be. Small pullback bull trend that lasts all day. Here we get a gap, a gap, a gap. Here, we pulled back below that high with the body gap. There's a body gap here, body gap here. So the low overlaps the breakout point, but the bodies do not. So gaps and body gaps increase the chances that you're going to get a bull trend that lasts all day. And if your gaps are closing, it's less likely that the trend will last all day. Gaps and body gaps. Strong trends form gaps and body gaps, and much better chance of the trend lasting all day. Two legs down, 12, 15. So for the bulls, it's a high 1. It's not a high 2 because 14 did not go above 13, but it's a micro double bottom, 13, 15. Confusion typically results in a trading range. Traders are confident the market's not going to go too far, so they're willing to buy as it falls and sell as it rallies. Is it always in short yet? We have consecutive bear bars with at least one having a big body and closing near its low. I still think it's always in long. We still have not totally reversed the final leg up here. So this is a weaker sell-off than this was a rally. This is still probably a pullback from this instead of a trend reversal. But the bodies are overlapping more. These 3 bars almost completely overlap one another. That's sideways trading. High 1, but only for a swing. You cannot buy above 15 looking to scalp out with 5 or 10 points. You're risking 15 points. The probability would have to be 70% if you want to scalp out with 5 points, if you're risking 15 points, right? And is it 70% that it will go up 5 or 10 points before it goes below 15? It's not 70%. It might be 55%, but it's not 70%. And therefore, if you're buying above 15, you cannot be scalping out for 10 points. You have to be holding, hoping we break strongly above the moving average and we continue up here. It's still a reasonable buy, but it's a low probability buy. If you're buying something that has a low probability, you need very good risk reward. Since the risk is big, you need a very big reward. And unless you're willing to swing trade, you cannot take this trade. If you want higher probability, you wait for a better setup, or you wait for a strong breakout above the high of the day and above the moving average. Right now, probably sellers above 15, sellers above 12, probably sellers above 11. We're going sideways with a lot of overlap. I talked about early on how we were getting bad follow-through after the bull bars. Now we're getting more bear bars and weaker bull bars. So it looks like probably more of a limit order market here and less of a stop order market. So I'm not going to buy above 15. If we break strongly above the moving average, maybe I'll buy. But right now, this is a limit order market. The bears have sold below 11 or 12. Their stop is above 11. If it goes above 11, there probably will be sellers above. because of all the reversals that we've had today. Some bears will sell at the 15 high and sell more 5 points, 10 points higher. Others will start selling 5 or 10 points higher, or with a limit order at the moving average. Limit order market. It's limit order scalping. Traders sell above things, sell more higher, and scalp out. So it goes, they sell the 15 high, they sell more 5 points higher. If it dips below the 15 high, they can exit break even on their first sell and with 5 points profit on their higher sell. If the market is strongly bullish, the bulls will not let it pull back below that 15 high. It's not strongly bullish, so probably the limit order bears, actually I just checked on the 1 minute chart, it did dip back below the 15 high, so the bears who sold 5 points above, they made their 5 points. Still always in long, but less certain, lower probability. Bulls, I'd get out below a bear bar. I'd get out 5 or 10 points below a bull bar. Otherwise, you get out below 14. Bulls who are flat are waiting for a strong breakout above the moving average. Bears will try to get a double top at the moving average. Don't feel bad if you're flat. I'm currently flat. I did not buy above 15. Markets constantly test. We were at this price earlier and we sold off. We were at the moving average earlier and we sold off. Traders are deciding, can we successfully break above the resistance, or are we going to sell off a second time? You look at it and say, we just had 3 bull bars, how can we get a bear bar? Traders sold at this price 8 bars ago. So the bulls who bought at this price, if they held long, they're relieved to be able to get out around break even. So they're selling. The bears are always selling, especially around a prior high. If enough traders sell, we'll begin a swing down. That's how double tops form. Bulls who bought, and if they did not exit, when it gets back to their original price, they sell. And if enough traders do that, you get a second reversal down, a double top. To short below 18, the more 18 closes on its low, the more bears will sell, and the more bulls will exit. And the bigger the tail below 18, the fewer bears will sell. They'll wait for 19. And bulls, not a lot of buying going on here. That's why I said, if you're not long, it's okay. You just wait for a breakout, a strong breakout, and then buy higher, or you wait for a reversal and then buy lower. Reasonable for bulls to get out below 18. They could get out 5 or 10 points below 18 or below 15. For the bears, it's a double top at the moving average, but a fairly conspicuous tail. Probably better to wait to see if we get a bear bar closing near its low 19. You can see not a very good sell, 18. More limit order bulls bought the low. But the bulls need a breakout above the double top. The bears are trying to get a micro double top, 18, 19, in addition to double top, 11. But they want a bear bar closing near its low, 19. If they get it, it would be a reasonable sell. Remember I said bears would try to get a wedge or a double top at the moving average. And so far, they have a wedge, and now they're also trying to get the double top. The more 19 closes on its low, the more bulls will exit and the more bears will short. The bears would like 19 to close at the 18 low or below the 18 low. Otherwise, they'll wait. Reasonable for bulls to exit below 19. Okay to short if you're swing trading. We're still in a bull trend. So the probability is we're going higher. And therefore, if you're selling, it's not a high probability trade yet, but it's a reasonable trade. If you're selling, you're looking for a test of the low of the day. So you're willing to risk 10 or 15 points to make 50 or 60 points. Double top, bulls want a breakout and a measured move up, which would take us to above yesterday's low and up to the Globex high. Bulls trying to get the bull breakout. It's breakout mode. The bears want a reversal down from the double top, and the bulls want a breakout above the tight trading range and a measured move up to above yesterday's low and up to the Globex high. Always in long. So right now it's slightly more likely we're going up there. Going up there. Breakout mode, 50% chance a successful breakout and a measured move up, 50% chance the breakout fails and we reverse down. It's easy to look at it and say, oh, that's so unfair. Here we got a breakout, a close at a new high of the day, and instead of racing up, you have traders selling. That's because traders know breakout mode, 50% of the breakouts fail. So that means there are just about as many bears selling the close of 20 as there are bulls buying the close of 20. And we don't know yet if the breakout will be successful. We're always in long. We're in a small pullback bull trend. So the odds are slightly better that we'll continue up. But if the bears get a bear bar closing near its low, 21, bears will sell and bulls will exit. Is the character of the day going to change and become more bullish? Will the bulls start to get good follow through after bull bars, unlike 2, unlike 4, unlike 10? Are bulls going to buy closes? And will this accelerate up? Always in long. Some bulls bought above 20. Some will buy the close of 21. They'll buy above 21 if it closes near its high, taking a chance that we'll go well above yesterday's low. Unless the bulls make this more bullish, it's probably going to be a bull leg in a trading range, which means we'll get a bear leg. So the bulls are doing pretty much the minimum. A bull follow through, consecutive closes above the breakout point, both increase the chances that we go higher, but we're not breaking strongly. We're not breaking far above the breakout point. This is what the bulls want. They're not getting it. They want this, a whole bunch of bull bars, closing far above resistance, the moving average. That increases the chances that we'll go a lot higher. And we're getting more of this kind of a thing where there's a lot of hesitation, and it increases the chances we'll get a bear leg. If we do get a bear leg, it's probably not going to be that strong. If we get a bear leg, it'll probably test down to the 15 low. The market might be entering a trading range, maybe bar 11. The bottom of the range right now is here. Small pullback bull trend, but the body gap's closed here and here. We have another body gap, but it's small. Here's the breakout point here or here. And so far, the bodies are not overlapping. Bulls, I'd get out 5 points below a bull bar, 1 tick below a bear bar, that closes below its midpoint. Close on the high, still by the close by the market, get out below a bear bar closing near its low, get out maybe 5 points below any other bar, bull bar or bear bar closing near its high. Sometimes the market will form consecutive wedges. We have a wedge and then 1 pullback, 2 pullback. If we get 3, we might get consecutive wedges. That often is a reasonable sell. We're very close to closing the gap. So the market's telling us that it thinks it has adequately priced in the repercussions of the Russian invasion. You can argue this is already consecutive wedges. We have a wedge here, and then we have a wedge here. If enough computers see it as consecutive wedges, this could be the start of a reversal down. Because of the consecutive wedges and the failed breakout above 11, reasonable swing short below 23. Traders wanting higher probability will wait for 2 bear bars. Bulls, as I said, I'd get out below a bear bar closing below its midpoint and 5 points or so below any other bar. Sometimes the market will try to create a complex top, like 2 or more legs, a wedge or a double top, and it fails, and then you get a new rally, and then another complex top, a wedge, a second wedge, and then you get the reversal, similar to today, a wedge and then a second wedge, and then a reversal, a wedge and then a second wedge, and then a reversal, a wedge and a second wedge, and then a reversal. We have a wedge and a second wedge, but a tight bull channel, and this wedge began before the bear trend here ended, so it's less certain. Remember, I said there were problems with the rally, the body gaps closing, so it increases the chances, it reduces the chances that this is going to last all day. It increases the chances that we'll get a pullback at some point, possibly down to the 15 low. For the bulls, a high 124, but a bear bar, consecutive bear bars, that will attract fewer buyers. And for the bears, now they have consecutive bear bars. So you'll get some bears willing to sell below things, sell above things, sell above 24, sell below 24. Nothing is clear. We're still in a small pullback bull trend, but it's not behaving the way small pullback bull trends behave when they last all day. So it increases the chances that will evolve into a trading range. It's still a small pullback, similar to this and this, but what's different here is we have consecutive wedges, and as I said, the rally is not behaving the way bull trends behave when they last all day. It's behaving more the way rallies behave that lead to trading ranges. So we're probably going to begin a trading range. This is a reasonable candidate for the start of it. It could be a tight range, sideways for 10 more bars, 20 bars up here, or it could be a broader range down to here or even here. But right now, it's probably in the process of evolving from a small pullback bull trend into a trading range. and that means limit order market. There has been a lot of limit order trading all day, all the way up. Bulls were buying below, bears were selling above. The bears who sold at a prior high all day made money, selling above 2, selling above 5, selling above 10, selling above 18. So limit order bears selling at prior highs and selling more higher have been making money all day because the bulls have been unable to create gaps and keep the gaps open. When bears can make money all day in a bull trend, the bull trend usually is not going to last all day. Usually you'll end up going sideways to down for at least an hour or two. For the bulls, a high 125, but a bull doji after 2 big bear bars and a wedge top. We might get one more push up, so it might become a wedge like this. So it might be 1, 2, 3. We closed the body gap. Did we close the body gap? Maybe not. Let me just check. So this is a breakout. We broke out above that. The highest close is that. So the body gap is still open. But if 26 closes below that red line, then the body gap will be closed again for the 3rd time. And that's not good if you're a bull hoping that the trend will last all day. Still a high 1, but I suspect sellers above. We have possible consecutive wedges. A lot of bulls would like to buy a high 2. So you'll get fewer bulls willing to buy above 26. If we go sideways for a few bars and get a high 2, you'll get more bulls willing to buy. I suspect we're going to try to get above 4,200. The bears will try to keep the gap open, but I think they've already blown their advantage. They should not have allowed this much of a rally. So even if today does not close the gap and does not close on the high, there was persistent buying for a couple hours today. I think it reduces the chances that the market's going to go a lot lower. As I said, I've been saying it might get below 4,000. I still think that's true, but I also do not think it's going to reach the pre-pandemic high, that February high. Weekly chart, this is the pre-pandemic high. I don't think we'll get there. I've been saying we'll get down into this gap area, a gap between these lows and these highs. We have a breakout, and it's around 4,000. This gap on the weekly chart here is also a gap on the monthly chart, and obviously a gap on the daily chart. So I think that's where we'll probably go. I don't think we're going to go much below that. What if Russia tries to take more territory? I don't think they're going to try to take all of Ukraine in the current war. You know, they want to take all of Ukraine, all of Bulgaria, Romania. You know, they want to reconstitute the Soviet Union, but it's not going to happen. Russia is basically just a big North Korea. So nuclear weapons, and so they can threaten people, but they don't have the economic clout to get a lot of support from other countries. You know, Europe, for example. Europe does not want Russia to take over all of Eastern Europe. And Europe has a lot of economic clout, a lot more than Russia has. So, you know, what eventually is going to happen is Russia will be financially ruined if they keep pushing west, and that's, you know, so I don't think that's going to happen. As I said, they're just a big North Korea, you know, nuclear weapons, and that's it. You know, no money, no economic power. I live in California. The economy in California is bigger than the economy of Russia. Bears trying to get a breakout and a measured move down. Remember, targets below are these higher lows. Might get all the way down to the low of the day. Right now, probably not. So right now it looks like we're probably not going to, break out of the Globex range. If we do, I still, I don't know. At this point, I don't have an opinion. We're right in the middle of the Globex range. The Globex range is huge. I suspect today we're not going to break out of the Globex range. I think we're probably not going to get above the Globex high and above yesterday's low. And I think we're not going to get below the Globex low. We have a breakout point here on the Globex chart. So might come down and test that again. Is it always in short yet? No, but if we get consecutive bear bars, 27, 28, it could be always in short. But as I've been saying since the open, trading range, trading range, trading range. I still think, even though it's a bull trend so far, I said all the way up, it looks like a bull leg in a trading range. And trading ranges have bear legs. It looks like we're in a bear leg. The bears have a breakout, 27 closed below 26, but it's a trading range. And therefore, you have to assume the follow through is going to be bad and that the bulls have bought the 26 low and bought more lower will make money. You buy the 26 low, 25 low, you buy more 5 points lower, betting it'll get back above those lows and you can make your 5 points. So not strongly bearish. I did sell during 24 and I scalped out. When the market's probably in a trading range, I tend to scalp. So I take a trade hoping that my entry will grow into a huge trend bar, knowing it probably will not. When it does not, I quickly scalp out. Whenever the market is in a trading range, bears will sell, bull closes 26, bulls will buy, bear closes 27, and they'll use wide stops and scale in. For the bulls, a double bottom 19, 2 legs down, 14, 27, so a little bit of a lower double bottom, 25, 28, but not so good for stop order bulls. A 6-bar bear micro channel and a break below the bull channel, and another body gap that closed. So we're in a bull trend and we're breaking below the bull channel, probably transitioning into a trading range, still always in long. A failed breakout 27, closed below 25, and we're failing. A lot of the bears are buying back shorts, but for the bulls, it's only a small bull bar after a bigger bear bar, and it's a 6-bar bear microchannel. So I think not a very good buy. Bears, they want to sell, but they might not want to sell this low below the high of the day and above a bull bar. However, they might sell 5, 10, 15 points above 28. And bulls, it's not good enough for me to buy. I think we're going to try to get down to the 15 low, possibly lower. I think this is probably the start of at least an hour or more, probably more like 2 hours of sideways to down trading. It could be sideways, we could get back up here and form a trading range, or it could be sideways to down and get down here or here. Bears want a lower high major trend reversal. Bulls are hoping the bull trend continues up to above yesterday's low, 4,200, and the Globex high. The more bull bars we get, the more traders will buy closes betting on the reversal up to above yesterday's low. Important bar here, if it closes on its high, you'll get more bulls buying closes. If it does not, you'll get more bears selling closes betting on a lower high. Trading range since 18, possibly a trading range since 11. If we come down to the 415 low, then traders will say the trading range began here. We're still in a bull channel. 28 fell below 19, but only a little bit below. It held above the 15 low, which is a major higher low. So for the bulls, it's still in a bull channel, and it's still always in long. The bears needed a second bear bar after 27, did not get it. Bulls buying here, I'd get out a tick below a bear bar closing below its midpoint, maybe 5 points below any other bar. I still think it's slightly more likely this is a trading range instead of a resumption of a bull trend. As I said earlier, it's enough of a reversal to reduce the chances that today's going to be a bear trend. Too many bars up, almost half of the day going up, plus up a lot, up about 100 points, 90 points. So it reduces the chances we'll get a new low. So we've probably seen the low of the day. By the close of bar 18, 80% chance we've seen either the high or low of the day. It's much more likely that we've seen the low of the day. And so even if we sell off, we'll probably get a higher low. A lot of two-sided trading, limit order bears making money all day. So I think we're probably in a trading range 18. The bulls are hoping this is a resumption of the bull trend and that we break strongly above yesterday's low. If we do go above yesterday's low, we'll probably close the day right around yesterday's low on the daily chart. Yesterday was a big bear day, closing near its low. Today so far is a big bull day, closing near its high. So if we do get above yesterday's low, we'll probably close right around yesterday's close. So big bear day, big bull day, both closing around the same price. A magnet, which is around that low. Can you sell? Lower high, major trend reversal, 31. With 3 bull bars closing near their highs, I think most bears are not going to short below 31. Maybe if it's a perfect 2-bar reversal with 30, you'll get bears selling. But a lot of the bears will want a micro double top. Unclear, and unclear usually means trading range. But we're still in a bull channel. We have really important magnets that are within reach. So I suspect we're going to get up. I think we're probably going to get up here at some point today. I don't know if we'll do it right now or if we'll go into a trading range for a couple hours and then go up there. Bears are hoping we go into trading range and then down here, or here. But right now it's still more bullish than bearish, but difficult to trade because we're not getting a series of strong trend bars in either direction. So traders are taking trades and scalping. A lot of traders are limit order trading and scalping. Even though it doesn't look like it's outside up, it is. The 60 low is at the 59 low, and the 60 high is a little bit above. We're obviously in a bull trend. We had a bull trend here and then sideways here for a couple of hours, sideways to down. We had a wedge top here. We broke above it. The breakout failed, and we have a micro double bottom, and the bull trend is resuming. We should get to the Globex high. We're so close to it, we probably have to get there. I don't know if we go much higher than that, but that's where the market is headed right now. It's possible that we go up for a measured move based upon the Globex double bottom. So we got a double bottom here, neckline there. It's right around the Globex high. So the double bottom does not add any information. The bears tried to get a reversal down 53, a failed breakout above yesterday's low, the pink line. And there was a wedge, 1, 2, 3. And we had a reasonably strong reversal down, but it failed at the moving average. And the bulls got a micro double bottom, outside down. So it's 2 lows, down 55, up 55, down 56, up 57. So theoretically, it's a buy above the neckline 56 or above the bull bar 57. And we should go at least a little higher, up to at least one tick above the global XI. That's not a lock, but 90% of days break out of the Globex range. We're late in the day. It's unlikely we'll break below the Globex low. So if we're not going to go 100 points, 120 points down in the next hour and a half, we're probably going to go another 10 points up above the Globex high. And that's what's going on here, a magnet up. It's possible that we can reach the 60-minute moving average today. We're also trying to test yesterday's close. If you can see here, we're still down on the day. But if we get to the Globex high, we should get to yesterday's close. What will happen when we get there? Some bulls will take profits. Those are reasonable targets. And if the market hits a reasonable target, you're always going to get some profit taking. Bears want a wedge, 22.53, but we're so close to the Globex high, you got to bet we're going above the Globex high. It's possible that we then reverse down, but I doubt we're going to get much of a sell-off. I commented earlier today that we had an unusual number of big bull bars closing near their highs, and that made a bear trend day unlikely. I said today would probably either be a bull trend or it would evolve into a trading range. And it did both. We had a bull trend and then sideways for 2 or 3 hours, and then we're getting bull trend resumption here. Can you short right here? Nope. I would not be selling at the market because we're going higher. We're going to go to the Globex high. So why sell now when we're going to go at least a little bit higher? If we get a reversal on 62 or 63, traders might sell it, but if 61 closes on its high, the bears will want a very good sell signal bar, 62. We're right at the Globex high. We just went above the Globex high. You can see on the chart there that we're just a little bit above the Globex high. That's the minimum target. So you might get some profit taking here. For the bears, the consecutive wedges, a wedge here, and then bull trend resumption with a wedge here. Different ways to look at it. 1, 2, 3, or 1, 2, 3, or 1, 2, 3. However, you got 4 bull bars closing in their highs with 3 of them big. So the bears would need a really good-looking sell signal bar. Most traders looking to short will wait for it to stop going up, begin to go sideways for 2 or 3 bars, and then think about shorting. Can you buy the market, buy the close? We're right at a profit-taking area. So it's really not a good location to buy the close. You can always buy, but you'd have to use a wide stop, maybe below 59 or 56, and use a wide stop and scale in. So you'd have to trade a very small position if you were buying right here. You can always get out 5 or 10 points below any bar, including a bull bar, and then buy again the next time there's a bull bar closing near its high. So if you get out below 53, you can buy above 57. If you get out below 47, you can buy again above 49 or 50. I think today's a really important day. It's telling us that traders do not think the Russian issue with Ukraine is going to be all that important. It's obviously very important for the people in Ukraine, and if you live in a neighboring country, Poland, you might be, obviously it's going to bother you a lot. Estonia, any of the Balkan countries, but the American stock market is not going to get affected very much, and that's what today is telling us. Might get some profit taking. Yesterday's close, yesterday's low, the Globex high, but minor. This is now an 8-bar bull microchannel. So the first reversal down will probably be minor. Bulls, they can get out below a bear bar. They can get out 5 points below a bull bar, 62. And for the bears, it's several different ways to look at this as a wedge, but it's a strong enough rally. I think most bears will wait to see if we get a micro double top or 2 or 3 bear bars before shorting. Probably a minor reversal. Remember I said earlier that we may end up closing right around yesterday's close. Yesterday big down, today big up. Sometimes when you get that kind of a thing, the second day is almost exactly the same number of points as the first day. So that's yesterday's high, yesterday's low, and here's today's low and today's high. So today's range is a little bit bigger than yesterday's. You can see it went below the 62 low, and traders bought it because too many bars up without a pullback. Traders are typically going to buy the first reversal down, especially below a bull bar. But a lot of the traders who take a buy like that are going to scalp. They'll try to get 5 or 10 points and then exit, and that increases the chance that 63 will not close on its high. If a lot of the 62 low bulls are only bought for a scalp, it'll go up 5 or 10 points, which it did, and then the bulls will sell out of their longs. And if enough bulls are selling, it'll go sideways instead of up. You also have the buy the close bull 62. Some of them placed a limit order to buy more, 10 points lower, thinking that the market was going to do one of two things. It was either going to continue up and they could make a profit, or it would pull back and traders would buy the pullback. It's interesting that the limit order bulls who bought the 62 close, if they placed a limit order to buy 10 points lower, it looks like, they would have gotten filled. So if they bought that close and placed a limit order to buy 10 points lower, this fell more than 10 points, so they would have been able to get filled. Now, is this going to be like 56? A bear outside down bar and traders buy above? Okay, there's an obvious difference. This is an outside down bar at the top of a bull leg. This is an outside down bar at the bottom of a bear leg and at the moving average support. So 63 is not the same as 56. So there's less chance bulls will buy above 63 if it's a bear bar. In general, traders looking to buy above the high of the prior bar prefer to buy if the prior bar is a bull bar. And that's especially true if you're at the high of a leg up. Here we're at the high of the day. So you'll have fewer traders willing to buy above a bear bar up there. They'll buy above a bear bar possibly in a pullback, but they're less willing to buy above a bear bar at the high of the day. Now, different ways to look at this as a wedge, but it's there's an 8-bar bull microchannel 62. I think it's probably a minor reversal. Bulls, they can get out below 63, a bear bar closing below its midpoint. They can always buy again if 64 is a bull bar, a high one, like here. If bulls get out below 7, they could buy above 8. If bulls get out below 11, they could buy above 15 or above 13 or above 16. $53 or 63 is a pullback. It's outside down, so it's pulling back in a bull trend, and therefore it's a high one buy signal bar, buying above 63, but it's a bear bar at the top of a buy climax. So there might be more sellers than buyers above 63. And remember I said that, well, let me rephrase it. Let me say it this way. You got bulls who are buying all the way up, confident one or two things will happen. It'll go up more, they can make a profit. It'll go down, they can buy more, get out, break even on their first buy, and a profit with their second buy. Now, this is a special thing right here. Buy the close bull 62, disappointed 63. So if you bought the 62 close or above 62 and you see 63, you're thinking, it might start to pull back. So a number of those bulls, we don't know if it's the majority or just some, will decide to get out around break even. They will place limit orders around the 62 close, 62 high. If enough of them do, we'll turn down again right here, now that we're back at those sell limit orders, and you get a micro double top. That happens all the time. That's how you get a lot of micro double tops and micro double bottoms. You get disappointed bulls. They bought 62, they're disappointed 63, they decide to get out break even 64. If enough of them do that, we get a micro double top and a swing down. But we don't know. There may be more bulls looking to buy above 63, expecting the market to reach the 60-minute moving average. I'm not going to buy above 63, the bear bar. We're probably not going to break above the 63. We're probably not going to break above the 60-minute moving average. We might get there, but I don't think we'll break above it. What about if 64 is a bull inside bar, IOI? Can you buy above that? I think that we're probably not going a lot higher over the next few bars. I do not think we're going to successfully break above the 60-minute moving average. Look at today's range on the daily chart. What do you notice? Here's the daily chart. It's a really big range, right? It's as big as any of the days. There have been very few days bigger than today. This one was, but the other days are really not noticeably bigger. What are the chances today is going to become a lot bigger? Small. So what are the chances we're going to get much above the 60-minute moving average? Small. If we did break out far above the 60-minute moving average, today would be an exceptionally big day. And exceptional means low probability, and that means it probably will not do that. So a high one, we pull back 63, you could buy above the bull bar 64, but probably not very much more to the rally. I'm not even certain we'll reach the 60-minute moving average without more of a pullback. We still have an hour to go. We could pull back for a half hour sideways to down and get closer to the moving average, and then at the end of the day, get one more leg up. But I think you're going to have fewer bulls willing to buy at the top of a buy climax after a bear bar 63. They're afraid that a lot of the bulls who bought 62 will be trying to get out around break even, so you'll have a lot of bulls selling. And if there are enough bulls selling out of longs, we will get a pullback. The bears know disappointed bulls will sell around 62. So what will the bears do? They'll sell around 62, adding to the selling. And we don't know if there's a critical mass of sellers, bulls exiting break even and bears going short for a minor reversal down. If there are enough traders to create 54, 55, 56. It obviously became a much stronger bull trend, 52. So traders are looking to buy, but there may not be enough of them willing to buy at the high. So we may have to get some profit taking and a pullback before the bulls buy again. And the bears know that, so you'll have some bears starting to sell. Betting will get a pullback. I think it's better to buy a pullback, but if we get a second sell signal, a micro double top with a very good sell signal bar, you will get bears selling below 65, taking a chance that we drop below the breakout point 53 and test the moving average and test yesterday's low again. you can see we're not getting a lot of eager buyers after seeing 63. Bears trying to get a second reversal down, failed breakout above the high of the day, 53, and failed breakout above yesterday's low. But stop order bears need a very good bear bar, a bear bar closing on its low. And even then, I think there will not be a lot of bears taking the short because they expect it to be a minor reversal. Will 66 close on its low? If it does, you'll get a lot more bulls exiting, and you'll start to get bears shorting. But the bears shorting, despite different ways to look at it as a wedge, is still probably only a minor reversal. So many bears will look to scalp out 10 points or so, maybe a test of the 53 high in the moving average. Inside bar, so a high one, but is anybody going to buy above 65? It's a third leg up, 62, 65. So a micro wedge nested within a bigger wedge, 1, 2, 3, or 1, or 1, or 1, 2, 3. So not a lot of buyers, certainly not a lot of buyers above 65, 66. However, there probably are not going to be a lot of eager sellers below 66. So the bears selling below 66 are hoping that we get a quick move down, 54, 33, right? But we may not. We may instead go sideways, like 48 or 41. So the bears shorting are betting, taking a chance that we're going to get a very quick move down. And then they can take partial profits at 10 points and hope that it turns into a bear trend. They know it probably will not. In other words, it's a low probability sell, but they're willing to take the chance because it's possible that will come all the way down here and they can make 50 or 60 points. The day could end up closing in the middle. Unlikely, but the reward is so much bigger than the risk that a low probability trade is still a reasonable trade. The bulls, another inside bar, another high one, 60-minute moving average magnet above, but a micro wedge, 62, 65, probably not going to go a lot higher. So anybody buying above 65, 66, they're probably going to have to make quick decisions because it's probably not going to do what they hope it will do. They're hoping it breaks strongly. They hope it looks like 52. It's probably not going to look like 52. And for the bears, it's a low 2, but possible tight trading range. So instead of down, it may simply go mostly sideways until we get to the moving average. And then maybe the bulls will buy around 1230, 1235, hoping for one more leg up. So spike, pullback, second leg, pullback, third leg. Not a good stop entry buy because probably not going much above the 60-minute moving average, and not a good stop entry sell because the bull channel is so tight, 56. So what do? Best choice, wait. Wait to see if we break above 66, which we're doing, and maybe get a reversal 67, 68 for a micro wedge, or wait for a pullback to the moving average and then a bull bar, and then buy that, 49 or 57. Since it's probably not going to get much above the 60-minute moving average, can you sell with a limit order at the 60-minute moving average and scale in higher, 10 points, 20 points, 30 points? In the final hour, selling in a strong bull trend with limit orders is a bad idea, so I would not do it. Sometimes you'll get a squeeze. The bears who shorted in here, running out of time, they panic and buy back their shorts, and the market can get a big rally, a very big bull bar. That's fairly common when you think the market might be topping, and instead it breaks out and you get a huge bar. Opposite's true like this, this kind of a thing. You think the market might be topping, and then you get that. And the opposite is true. If you think the market might be bottoming, sometimes you'll get a collapse. Kind of like this, the market was trying to bottom. And then we did that. Possibly more sell the closed bears than buy the closed bulls. It's a third leg up, 62, 65, and it's just at the 60-minute moving average. I doubt we're going to get much of a reversal if we get a reversal, but possible micro wedge, maybe a wedge, 1, 2, 3, or 1, 2, 3. I would get out of longs below a bear bar. If we do get a bear bar 68, closing on its low, it's a credible short or a pullback to the bottom of the tight range, maybe to the moving average, maybe to yesterday's close. Bulls, probably, I think if you're long, I would get out below 68 if it's a bear bar. If it's a bear bar closing there its low, you will get bears selling. One problem about 68 is if it remains small, the stop placement is a problem for the bears. Because whenever you sell and you have a small signal bar, the market often goes above the top of the sell signal bar and then reverses down a second time. That's a very common thing. A small signal bar, if you sell below 68 and you put a stop one tick above 68, you're not risking very much. That means you have great risk reward. Great risk reward always means low probability. And that means if you have a very tight stop, very little risk, you're probably going to get stopped out. So one way to handle it is if you take a short like that below 68, you use a wider stop, maybe a measured move up based on the height of the bar. So a stop up here instead of one tick above. The other alternative is if you're selling, you just trade very small. And then if it goes down, you sell more as it goes down. This is what I'm talking about in terms of a small signal bar. It's a low probability bet if you put a stop just above the high of the bar. So here we're rallying, and we have a bear bar here, and it's possible wedge, 1, 2, 3, reasonable sell, but the bar is very small. Whenever you take a short below a small signal bar, great risk reward. Look how much reward compared to the risk. It's tremendous. That means tremendous risk reward. That means low probability. So if you take a sell like that, it's reasonable to use a stop maybe twice the height of the bar to allow for the possibility that the market goes above the bear bar and then goes down a second time. Alternatively, you don't take the sell, you wait for the second entry, or you wait for a big bear bar and then sell. The bulls, it's a high one above that bull bar, but it's not, even though it's a tight bull channel, we just had a sell signal, and it's a small sell signal bar. The market may go a little bit above and then reverse down the second time. Small sell signal bar, low probability. Look how much reward, huge reward compared to the risk. So if you're taking the short, it's probably better to use a stop more than just one tick above the high of the bar. Small sell signal bar. Better to use a wider stop instead of just one tick above the high of the bar. Okay, this is a close-up, a relatively small sell signal bar. If you take the short, it's probably better not to put a stop one tick above the high of the bar because it'll often hit the stop and then go down. In this particular case, if you took the short, you did not make much money, if you made any money at all. But the message is, whenever your risk is very small compared to your reward, you're probably going to get stopped out unless you use a wider stop. Right now we have a gap between the 59 or the 69 low and the 66 high, 67, 65 high. Bulls hope for a measured move up, maybe from that low to that high. It's just a little bit above where we are. But I think we're probably not going to go a lot higher. We're not quite at the 60-minute moving average. So might go a little bit higher, but I think the odds are we're not going to go a lot higher. So the bull's an outside up bar in a small pullback bull trend, but we just had a sell signal bar. We're at the 60-minute moving average. We're pretty far above the moving average. So not great math. If you're buying above 59, you're hoping we get 61 or 52. You know we probably will not. Bears are hoping for a second reversal down. What just happened here is some bears have sold below 68, disappointed 69, placed limit orders to buy back their shorts, break even. And that's what's causing this little bounce here, 70. The bears who sold, disappointed, they were able to buy back their shorts. It's still, I think, reasonable to be short. It would be better if the bears can get a second sell signal bar, 70. They'll have a higher probability of a pullback, maybe to the bottom of this tight trading range in the 60-minute, and the moving average. Bulls still trying to break strongly above the 60-minute moving average, but I don't think they'll be able to get much above it. That tail, 70, tells us that a lot of the bears gave up. They bought back their shorts. We don't know if enough of them gave up to create a successful break above the 60-minute moving average. But as I said, I don't think we're going to break much above the 60-minute moving average. Micro double top, up 67, down 68, up 69, down 70. A triple top, up 70, down 71. Are there enough bulls to break above 70, run the stops of the bears, and continue far above the moving average, 60-minute moving average? I don't think so, but we'll find out. And the bulls who are long, if they have not given up, if we start to go down, they could give up, and we could go down pretty quickly. Remember I said we might close around yesterday's close, which is around the 63 low area. Breakout mode, a tight trending range at the top of a buy climax at resistance. Bulls hope that we break strongly above, and bears hope that we reverse down sharply. It's not quite a ledge, but it's almost a ledge. For me, I use the term ledge if you have a tight trading range and 4 bars in the range having identical highs, or ledge bottom, identical lows. So this is almost a ledge. It's 3 bars with identical highs. The computers, you got the bear computers selling with limit orders at the 69 high, and the bull computers trying to squeeze the bears, trying to break above 69, make the bears give up. So it's breakout mode. One side will give up. It obviously is more bullish than bearish. So at this point, it's more likely that we're going to go a little bit higher, especially since the 60-minute moving average is still above where we are. But I do not think we're going to go far above the 60-minute moving average. Now there are 4 bars with identical highs. So now it's a ledge. 72, if it goes above, then it would not be a ledge anymore. But if 72 does not go above, then it's still a ledge. A ledge is a magnet. So if we were to reverse down here without breaking above the ledge, we will get back above the ledge tomorrow. It's possible that we could get above it today if we were to reverse down, but we're running out of time. R72, a multiple of 12. It corresponds to the close of the 6th hour. And on the 60-minute chart, we have consecutive good-sized bull bars closing near their highs. We're right at the moving average, 60-minute moving average. Bulls hoping we break strongly above it today. Bears hoping we pull back. But overall, I think today's price action is very good for the bulls. It increases the chances that we've seen the low and that the bull trend will resume. The bulls need to start to get several consecutive bull bars on the daily chart if we're going to reverse up in a V bottom. We might do this, go sideways for several bars, take a week or so to decide if Ukraine is going to become a bigger problem, and then if not, begin a very sharp rally. This is what I was talking about for the wide stops for the bears. Because when you have a small sell signal bar, chances are it's going to go above the sell signal bar. And it did. 69 went above 68. Bar 72, the final 5-minute bar of the hour, sold off. And it put a prominent or conspicuous tail on the top of the 60-minute bar. So that one bar on the 5-minute chart was enough to weaken the bullishness of the entire hour. Bulls trying to get a high 173, and the bears are hoping to get consecutive bear bars. As I said, we might simply go sideways and finish the day around where we are. Bulls, I don't think we're going to break strongly above the 60-minute moving average. And I don't think we're going to reverse down all that much. We may get down and test yesterday's close, yesterday's low, but I doubt we're going to go much lower. So I don't think we're going to go very far up or down into the end of the day. The bears have sold below 68. It looks like a lot of them were disappointed 70, 71, 72, and they may have scalped out with 5 points. Bulls trying to get a high 173, but top of a tight trading range. That will reduce the number of bulls buying above 73. If you buy, you're taking a chance that we will successfully break above the 60-minute moving average and maybe rally 20 points from here. As I said, I don't think we will. We have an outside bar of 71, a bigger outside bar of 72, and now we're breaking above the 0073. Often leads to a measured move based upon the height of the 00, which is the height of the second of the two outside bars. Very good bar for the bulls, but we're around the measured move target based upon the height of the 00. Next target, the January 28th low. That was a breakout point. The bulls tried to have a micro double bottom, and we rallied strongly. Then we broke below it. So it was support. It failed. Theoretically, it's resistance. It's still a magnet. Open of the week. The week is still a bear bar on the weekly chart, and the bulls would like the week to be a bull bar. So if tomorrow closes above the open of the week, then we'll have a bull bar on the weekly chart. Bull breakout and follow through, but probably not a lot higher. Bulls, I'd get out 5 points below a bull bar, 1 tick below a bear bar closing below its midpoint. And for the bears, they had their chance. They had 2 or 3 reversals down here, unable, and instead we're breaking above the 60-minute moving average. So it's probably not going to be a sell signal again today. The question is, do we continue up or do we go sideways into the end of the day? Not a lot of traders are going to be willing to sell with stops unless we stop going up and start to go sideways for a few bars. And that takes a few bars, and then there's very little time left in the day. So not good for the bears. What do you do here? I think nothing. Late in the day, a bear bar, buy climax at resistance. I would get out of longs below 75 and wait for tomorrow. I would not take the short the bulls are hoping to get a high 176, but I don't think we're going to go up very much. So I would just let it go. People are buying stocks aggressively into the close today, betting that we've seen the low. And that's why the market's doing this. I'm buying stocks. A lot of people are buying stocks, betting that this is going to be the low. One problem stop entry bulls have on the daily chart is the bar is so big that a lot of traders will be hesitant to buy above today's high. Like this, I talked about that back here. When you get a really big buy signal bar and everybody wants to buy, a lot of traders are hesitant to risk too much, and therefore they'll try to buy a 50% pullback. And that's what took place in here. Some of the bulls who wanted to buy did not want to buy here. They waited for the market to drift down in search of buyers, and then they bought about halfway down. And that might be the case here as well. The bulls who did not buy, the bulls who bought here are going to hold if we get a 50% correction, because they know the bulls who are not yet long are going to buy. So the market's telling us that Russia is not going to be a significant problem as far as our stocks go. And the market also already knows the Fed is going to raise rates a lot over the, they might raise rates 5 times, 8 times over the next year or two. So that's already known as well. So the market is here having digested 2 bearish things, all the rate increases that are coming and Russia's invasion of Ukraine. And the market thinks, we've probably gone down too much. The news is not as bad as traders thought it might be, and therefore traders are buying. Monthly chart, I said the pullback would probably last 2 or 3 months, and it might be like this 2 months. I said it could be like this 3 months, but I said if it was going to be 3, February would probably be a bull bar. I said we probably would not get 3 consecutive bear bars on the monthly chart. If February remains a bear bar, which it will, we only have a few trading days left. We only have 2 trading days left. It increases the chances that March will be a bull bar. Also, every March, what do I say? I always make the point in March that if you look at any consecutive months of the year, January, February, February, March, April, December, January, and you pick any consecutive months, and you look at the results of the stock market during any consecutive months, the pair of months that is the strongest is March, April. So we're also entering a seasonally bullish time of the year. Extremely good day for the bulls, and probably the most important day of the year for the remainder of the year. When you look at a bar like that, first of all, it's dramatic. It's extremely big, and it'll probably be the biggest bar for the remainder of the year. I've been saying that I thought we would correct for a month or 2, and we have. And for the bulls, we broke below this low, reversed up, we're breaking below it again, reversing up. I talked about the head and shoulders top. I said 40% chance of a successful breakout, and I measured move down, 60% chance. If we're not going to go down much if we break out. And we broke out today, but reversed up pretty dramatically. Today is probably going to be the biggest day of the year, and the context is good for the bulls. It's a failed breakout below a double bottom. It's a wedge, 1, 2, 3. A wedge, 1, 2, 3 here, and a very big rally. In the face of terrible news, Russia invading Ukraine. So I think it's a good candidate for a low for the remainder of the year. What we don't know is whether we'll get a V-bottom reversal and just go straight up to the high, or if we'll go up for a week or two and then sideways and continue the 8-month or 7-month trading range. We've been sideways since here, strong rallies, big sell-offs, but still in the trading range. I think today makes it unlikely that we're going to go a lot lower. I think the market is saying, this is probably the low. If we do get one more new low, it'll probably not be much below this low, maybe a little bit below 4,000 for a wedge, 1, 2, 3. But this today is telling us that either this is going to be the low for the year, or if we go lower, there probably will be aggressive buyers below, just like below here and here, they bought aggressively. And then a new low here, they bought aggressively. If we go below this low, below 4,000, they'll probably buy aggressively again. Weekly chart, tomorrow's the last day of the week. The bulls would like the week to be a good buy signal bar. They'd like the week to look like that, but it probably will not. The week will probably not close up above the current high and have a big bull body, but there's a pretty good chance the week will close above the open of the week and have at least a small bull body. For the bulls, a high 2, 1 pullback 2, and a second reversal up from the bottom of a 7-month trading range. Monthly chart, we had outside up and then outside down in January. That was the second back-to-back pair of outside bars on the monthly chart, outside down, outside up here. So I said that was probably enough so that we'd have to trigger the 00 sell signal and go below the January low, which we did today. We're also at the 20-month moving average support. There was support here and here, broke below it, support, it was support, 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 and might be support here. I've been saying we probably would get 2 bear bars in the correction, maybe 3, but unlikely to get 3 consecutive bear bars. So I suspect the correction is over. What we don't know is, will the bull trend resume and will we go up to a new high from here, or will we just go sideways like this? Here we were sideways for 2 years. Don't know yet. The daily chart looks good for the bulls. It looks like we'll probably go up here, possibly all the way up to a new high. 5-minute chart today. We had a very big gap down and a bull bar, bar 1, a very big bull bar, but it did not close on its high. So I said a lot of bulls will wait to see if we get a second consecutive bull bar, which we did, bar 2. So bulls will buy the close of 2 or above 2. 3 was a bear bar, but nobody's going to sell below 3, even though it's a bear bar, because of 2 things. We're far below the moving average, yet we have 2 very big bull bars. If you're going to short far below the average price, you better be selling something that is far above average bearishness. And instead, we had 2 big bull bars, so nobody wanted to sell below 3. And in fact, 4 did not even go below 3. There were so many eager bulls looking to buy a 50% retracement of the first 2 bars and buying at or below the 3 low, it could not get below 3. 4 broke out, but then bad followed through 5. 6, a high 1, did not trigger the buy. The bears got a micro double top, reversal down, up 5, down 5, up 6, down 7. But we're still pretty far below the moving average. And in the first 6 bars, 4 were big bull bars. So I think the reversal down is minor. The bulls got a high 1, bar 8, a micro double bottom, 6 and 8. It looks like we're in a small pullback bull trend. Reasonable to buy above 8. 9 and 10 both closing on their highs. Bulls will buy the market. 10 is close to the moving average and a third leg up, so we might get a wedge reversal. The bears tried to get a wedge reversal 11, but a fairly conspicuous tail, a wedge reversal at the moving average. Plus, it was following 3 bull bars closing near the highs, and 7 of the first 10 bars were good-sized bull bodies closing near the highs of the bars. So it's probably a minor reversal. We had 2 legs down, 12 and 14, and a high 1, 15, but it was only a doji bar. That will reduce the number of bulls willing to buy in a 5-bar bear microchannel. 16, 17, not breaking strongly above the moving average. The bears tried to get a double top 18, but a bear doji after 3 bull bars, not enough reason to sell. The bulls got a big breakout 20, but a fairly conspicuous tail. So it's a small pullback bull trend, but it's really not all that strong at the moment. 21, a doji bar. So a lot of the bulls are looking at this as a possible trading range, bull leg in a trading range, and they'd rather buy a pullback instead of at the high. 22 closing on its high, but reversed down 23. So I talked about it as consecutive wedges, a wedge 1, 2, 3, and then again 1, 2, and 3. But it's a tight bull channel, and I think we've seen the low of the day. So if we reverse, we'll probably get an hour or two of sideways to down trading, and then the bulls will try to get trend resumption up. We had a high 1, 28, a lower low double bottom 25, but a 6-bar bear micro channel, probably a minor reversal up. The bears have a lower high major trend reversal 31, but a doji after 3 more bull bars closing near their highs. We are getting a lot of bull bars closing near their highs. That reduces the chances that we're going to go down very much. So I think we'll either remain in a bull trend or enter a trading range. Bear surprise bar 32, follow through 33. Maybe it's always in short, but I think more likely a trading range. Maybe we'll get down to the 15 low or the 8 low. The bulls, a micro double bottom 36, 34, a high 2, 28, 36. It's an okay buy, but we've got 3 big bear bars. I'm not confident we're going to go up all that much. 38, a bull bar closing on its high, closing above 37, closing above the moving average. A breakout, but barely above the moving average. And we might get another lower high, 31. And we did. 39, 40, a lower high, but I'm not willing to short. 41, a high 1, but a doji after a bear bar at the moving average in the middle of a trading range, not good stop entry buy. Outside down 42, but we might get a higher low after the high 2 bottom 36. We're also near the bottom of a trading range. I don't want to be selling too low. Bulls, a higher low 43, but a bear bar, 4 bear bars. 44, bull bar closing near its high, possible higher low in the start of a bull trend, but not all that big. And we may get double top 39. So not great buying 44, 45. You can buy it and put a stop below 41, or you can get out below 47. For the bears, it's another lower high, 23, 31, 47, outside down. But 3 bull bars, higher low 43. I'm not willing to short. So market's in breakout mode. The bulls want a breakout above the wedge 47. We have a wedge 3 legs up, 36, 39, 46. It's a lower high double top 30. And the bulls want a breakout above, the bears want a breakout below, breakout mode. 50, a breakout. 51, a big bear bar closing near its low. Possible double top 31. Wedge 39, 46, 51. But bull breakout 50 closing far above the moving average and above 46. So it's a reasonable sell. I'm not going to take it. I'd rather see the market break back below the moving average. But it's also reasonable for the bulls to get out below 51. They can always buy again above the bull bar closing near its high or above the top of the wedge 51. 52, a really big bull surprise bar. It's one of those major bull surprise bars that can affect more than just the next 5 or 10 bars. It can affect the rest of the day, and it did. It was a spike up. We got a reversal down 53, but a higher low 56, 52. 53, it's a reasonable short. It's a wedge 46, 50, 53. It's a test of yesterday's low, possible high of the day. I would get out of longs, reasonable to short. High 155, but 2 big bear bars, we probably will get a couple legs sideways to down. So it might be more sellers than buyers above 55. Outside down 56, but still above the 52 low. So it's still a possible pullback to the moving average after the big bull breakout 52. Bull bar 57, It was almost an inside bar, but the bulls were so eager to buy, it went above the 56 high. So bulls will buy above 57, above 58, above 60, 61, 62. They'll buy below 62. It's about an 8-bar bull microchannel. But on 63, a bear bar, we're probably not going to break far above the 60-minute moving average. So fewer bulls will buy above 63, 64. Bull breakout 67, fail breakout 68. Not quite to the 60-minute moving average, might go a little bit higher, but this could be the high of the day, and we might pull back to yesterday's close and the moving average. So it's a credible short. It's a small bar, so if you sell below 68 and put a stop above, your risk is small. The market might reverse all the way back down here. So the reward is big. Great risk reward always means low probability. I'm going to go get a drink of water. I'll be back in a minute. Okay, I'll try again. So if you sell below 68, taking a chance that we reverse down into the close, down to around yesterday's close, yesterday's low, you cannot put a stop one tick above 68 because the odds are you're going to get stopped out. An alternative is to put a stop, maybe a measure move up based upon the height of 68. The bulls went outside up. I think it's also it's hard to see. 69. In any case, we did go above 68. We reversed down the second time, 70, but a tail, not a very good stop entry sell. The bulls again broke above 68 on 72 and then outside down 72. So if the bears get out, they'll get in again below 72. Instead, we went above 72 and the bears gave up, the remaining bears. I was short below 68 and I went long above 72. And I stopped myself. I scalped out on 74. The bulls high won, well, 75, a bear bar after a breakout, so it's a possible failed bear breakout, but it's a bull surprise. The bears had a reasonable sell, and the bears gave up 73. We should get a second leg up, so I'm not going to sell the reversal down 75. I won 76 for the doji. I doubt we're going to go up very much. I'm not going to buy it. And then 78, 79, I'm not going to sell it. Limit order traders, what would they do? In terms of high probability limit order trading, really not a lot of high probability typical limit order trading. Let me quickly go over here. 62 low, that's an obvious one, a very high probability buy. We're breaking out strongly. We have a magnet above. Nobody wants to sell below a bull bar 62. And up here, it's breakout mode. So you will, you will get bulls buying below. I shorted below 68. And after outside down 72, after running the stops on the bears twice, I thought if we would break above 72, we could get a run. So I went long above 72. I talked about body gaps down here, how we had a breakout 4, a pullback 6, it overlapped 2, so the gap was closed, but there was still a gap between the bodies, and then the gap closed. 7 overlapped 2, and the same here, 12 overlapped the body of 6. So we're getting body gaps that are closing, and that reduces the chances that this is going to be a strong bull trend. It increases the chances that we're going to enter a trading range. And we did. We were sideways for several hours, and then the market changed on 52, and we became much more bullish and very strongly bullish. We rallied about 100 points here in the final couple of hours. Stop entry traders, you can buy above 2, you can buy above 4, disappointment 5, you can get out below 5, buy again above 8, above 9, above 10. I typically don't take that one. Possible wedge 2, 5, and 10, but it's also right below the moving average, and there will be a lot of bulls taking profits at the moving average, expecting the market to pull back, possibly reverse. So when it's that close to the moving average, I typically don't take it. I did not buy above 15. I did not buy with stops above any of these bars. Next stop entry buy was 28. But I thought we were in a trading range, so you scalp out. You get 10 points, and then you wait for the next trade. You could take the short below 32, a double top 25, a lower high, major trend reversal, but I thought it was going to be minor. I would not buy above 34, did not trigger, but I would buy above 36, a micro double bottom, and a high 228. The breakout 38 was not big enough above the moving average for me to buy. 44, now we're starting to get higher lows. We had a lower low and two lower highs, and now we're getting a higher low 43, 44. So I'm looking to buy. I don't remember if I bought above 45, below 46. I don't remember, or if I bought the breakout 50. I did not. Did I sell? I'm saying I did not sell below 51. I don't know. I may have sold below 51. But in any case, I bought above 51 on the breakout 52. 53, a reasonable sell, but it's probably going to be minor. And the buy is above 57, 58, 60, 61, 62, 64. And then up here, I don't want to be buying with stops right below the moving average. Although I did buy with a stop above 72. I did sell below 68, and I did not do anything up there. When you write questions, try to keep them short, because if they're long, they have a lot of parts to them, and it's hard for me to keep all the parts straight, and it's hard for everybody else to listen to a complicated question at the end of the day. So if you have a complicated question, it's better to post it in the room. Yesterday, I turned 70 years old. Someone wished me a happy birthday. And it's just totally weird. You know, I can remember things from when I was 2 years old. You know, most people don't start to remember things until they're 3. But I have several very clear memories of when I was 2. And the reason I know I was 2 is because my memories are of the house where we lived when I was 2 years old. We moved late, right before my 3rd birthday, and I have several memories of the original house, which is kind of weird. Also, you know, I don't feel, you know, when I was a kid, all my aunts and uncles were dying, you know, 65 years old, sometimes in their 40s. And you know, now, you know, 65 is pretty young. And you know, I'm out there playing tennis. You know, everything wears out. You know, so my knees get a little sore. I've had shoulder surgery. You know, I broke my arm a year or 2 ago. You know, stuff wears out. But mentally, I still feel very alert, and I still feel really young. I'm very fit. I work out, you know, pretty much every day, either lifting weights or running or playing tennis. So it's just, you know, even though 70 is one of those big round numbers and a big birthday, you know, inside I don't feel like I'm old. I still feel pretty young and healthy. You know, I'm aware that you know, I know 70 is old, and you know, I have stuff wearing out, but that's not how I feel. I feel very much alive, very alert, and still very sharp. Not as sharp as I was, and not as hungry as I was 20, 30 years ago. Back then, I was trying to figure out how to do it, and now I know how to do it, and you know, so it's less thrilling. So I'm no longer like a puppy dog, you know, just jumping all over the place, happy to see everything. But you know, it's just, to me, it's just interesting that I'm 70, and if you asked me 20, 30 years ago about being 70, I would say, God, you're 70, you're a really old guy. And now, you know, that's not how I feel. I feel I don't ever want to stop working. I'm happy with what I'm doing, and I'm able to do a whole bunch of stuff. So I don't see any reason to stop doing anything that I'm doing. Okay, question. What is trading small when you are a professional? 2 contracts. Please give a few examples of people you know, no names. Trading small, I've talked about this before. If you've been trading for a while, you tend to have a lot of accounts. In fact, yesterday I opened another account at another broker. So, pretty much name the broker, I have an account. And part of that is a couple of reasons. One is stuff is going to happen. Bad things are going to happen in the market. And one of these days, prices will go out. One of these days, your broker, you will not be able to place trades with your broker. He'll have software problems, or Russia will just disrupt all the financial markets or disrupt the internet. Stuff is going to happen. And if I'm in a position and I decide that I have to get out of the position, and Russia disrupted the broker where I have my position, I want to be able to get out. And then the other reason, so I want to have a lot of escape hashes. And then the other reason is accounts are insured only for so much money. And once you have a lot of money, I don't want to risk having everything at 1 or 2 brokers and then having to get into some kind of legal fight with them when I'm 75 or 80 years old over, was there malfeasance on their part? Did they do something? So if my account disappears for whatever reason, I don't want to be having to sue anybody, and I certainly don't want to have some kind of devastating financial situation. About 30 years ago, I opened an IRA trading account with some broker. It may have been TradeStation, I just don't remember. And back then they said, Al, we don't want to be responsible for your retirement money, and therefore, if you want to open a futures trading account with us, you have to have the money not with us, but with a third party, a fiduciary. And the name of the country was Intrust. It later became Millennium Trust. So you put your money there, and you can trade with us, and they will be a safe haven for your money. And I never understood that. I thought it was dumb. Why should I trust them any more than I trust you? I'm happy to have you house my money, and I'll take my chances that you don't run off with it. And what happened was I got a letter in the mail, I don't know, maybe a year into it, saying all your money is gone. The head of the Intrust company ran off with your money and with everybody's money, and you no longer have that retirement account. Now, it was not a very big account back then, but usually when I open accounts, I open with a small amount and then see how I like the account, and then I transfer more money over. But it was just more a matter of here the brokerage firm is telling me your money might not be safe with us, but it will be safe with this other company. So put your money over there, and then we'll allow you to trade it. And it was just nonsense. They trusted the guy, and the guy was a crook. I don't know if they ever caught the guy, but I don't know if he ran off with $100 million or something. But he was a fiduciary, and he used it just as a personal piggy bank, and he ran off with everybody's money, and I never saw the money again. The company just disappeared, the money disappeared. So that's another reason why I have many accounts. Going back to your question, depending on how much money you have, that determines how much you trade. I don't know a lot of traders who are trading big accounts, big amounts. I've known some traders over the years who were trading big accounts, but most of the ones I knew were never risking more than 1 or 2% of their total trading accounts on any one trade. So if you have 10 trading accounts, let's pick a number. Let's say you have 500,000. Let's say you have $100,000 in 10 accounts. So your total trading account money is $1 million. 1% of it, is $10,000. So you're not going to be risking more than $10,000 or $20,000 on any one trade. If you're a swing trader and you have a wide stop, you'll trade 1 or 2 contracts. If you're a scalper and using a tight stop and the bars are small, whatever market you're trading in, you'll trade more. But in general, you don't want to be trading too much more. The biggest position I ever had was just a totally stupid position. Back when people were trading futures contracts, I think I was long like 130 currency futures contracts, which was totally stupid. I don't know how much I was risking, but it was just totally stupid. And one day I woke up and I decided that what I was doing was crazy, and I had to greatly reduce my position size. And it's interesting. I want to show, I don't know if I have the data for this, but I want to see. Okay. This is the Swiss franc monthly chart. And why am I showing the Swiss franc monthly chart? It doesn't go back far enough. But if you could see back about 25 years ago, there was one day in which the Swiss franc gapped down, I forgot what it was, like 1,000 pips, right? And you say, well, how can that be? How can that possibly be? Well, it did, okay? So one day, the futures contract gapped down about 1,000 pips or 1,000 points or something. And, something that should not happen. But as I said, lots of stuff that should not happen and is just unimaginable happens, like the 87 crash. And, if I were long, let's say 100 Swiss franc futures contracts, and the market gaps down 1,000 pips, and I exit, you can do the math, but that is a really huge amount. I think back then they didn't use the term pips; they used ticks, and I think it was like $12.50 per tick. So times 1,000 ticks, that's $12,500. Actually, I think it's times 10. But anyway, it would have been millions of dollars in losses, which would have wiped me out. But it's just one of those learning experiences. One of the many things you learn over time. You don't want to risk too much. I do know of traders currently now with big accounts, like $1 million account, trading 1 or 2 E-mini contracts, sometimes 3 or 4 E-mini contracts. I had a friend I used to trade with every day years ago. I used to trade with him online every day, maybe 20 years ago. And he was trading 4 E-mini contracts. I forgot if he was trading, if it was before the E-minis. I think it was after the E-mini. I'm trying to remember. No, he was trading 4 full-size futures, S&P futures contracts when the S&P future was still trading. And one futures contract then was 5 E-minis. But anyway, he was trading 4 S&P contracts, which today would be the equivalent of about 4 E-minis, given how much bigger the price of the stock market is now. But he had a big account, and I used to ask him. I used to call him Jay. I said, Jay, why are you only trading 4 contracts? You get millions of dollars. You've been doing this forever, and you're making 10 or 20 points every day. And he said, Al, I don't need the money. I enjoy what I'm doing. I don't want the stress. I'm just going to trade 4 contracts and make whatever I make. And but that's another guy who is trading, risking about 1 or 2% of his total trading capital. And I think it's not so much, what's the biggest amount of money that you trade. Everybody wants to know stories of rich guys. It's more, what you should be trading, and you should not be risking more than 1% of your position size. One of my buddies back in the 80s was the CEO of one of the movie studios. In fact, over the past 30 years, he's been the CEO of many movie studios. So if you want to figure out who he is, just look up who's been the CEO of all the major studios over the past 30 years. There's one guy, and that was my friend. And he used to have a driver take him to work every day. And every day on the way to work, he would trade 10,000 shares of IBM in his car driving to work. And I don't know how long it took him to get to work, but what he would do is he had a simple system. 10,000 contracts, 10,000 shares of IBM when it was $100, that's a lot of money. But anyway, he used to trade it every day in his car. Anytime the IBM would fall $1, he'd buy 10,000 shares, and fall another $1, he'd buy another 10,000 shares. Back then, IBM was the class act of stock market of companies on the planet. That was the quality company. Now a lot of you probably have never even heard of IBM, but back in the 70s and 80s, it was the bluest of the blue. It was the Apple of 1980. So he was very confident that it was never going to hold below $100 for long. So anytime it would go below, he'd buy 10,000 shares, 10,000 shares, 10,000 shares. And so that obviously is millions of dollars. But, the guy had hundreds of millions of dollars, so he was not risking much of his trading capital. So I'm not answering your question, but, if a person has $1 million in trading capital, they might trade, 5 E-minis, maybe 10, but, I think trading more than that is not worth it. Okay, final question. When trading CFDs, contract for difference, Forex on a bid chart with a fixed spread of 1.5 pips or 15 ticks, should I enter 1.5 pips above the bar for a long and at the exact low for a short? You say on the course that 1 pip above or below, but I can't see how this makes sense given since I'm giving away 2.5 pips on shorts and getting triggered early on longs. I've never had to trade CFDs because I'm in the Forex market, but he's talking about the problems of charts. And that's a real problem for scalpers. If you're scalping in the Forex market, some charts are created by the bid, some are based on the ask. One broker uses information from one bank, another broker uses information from another bank. And so the charts are just not all that clear. And it's really hard to get in exactly where you want or get out exactly where you want. And so it's just one of the difficulties of trading Forex markets. And that's one of the things that makes it difficult to scalp with Forex markets, especially scalping with stops. If you're swing trading, trying to make 50 pips or 100 pips, getting messed up by a 2.5 pip slippage or bad fill or the charts or whatever reason, there are a lot of factors that enter in getting stop entries that are not where you want them to be. I prefer to trade stupid. I put the chart up in front of me, and if I'm trading with stops, which is what I usually try to do, I just look at the chart in front of me, and if I'm trying to sell, I'll place an order like 1 pip below the low of the bar, or a buy stop 1 pip above the high of the bar. I understand if the chart is created by using bids, it's not going to be right. If it's created using ask prices, it's not going to be right. But that's how I would trade it. And if you find that you keep getting trapped into 1 pip traps and the market goes the other way, I would just not worry about having to give up 2.5 pips. I would just if that's what the chart tells you you have to do, that's what you have to do. And the only way to get around it is, go for a big reward or trade a higher time frame chart, so that the 2.5 pips become less significant. So you trade, a 15-minute chart, a 60-minute chart, a 2-hour chart, a 4-hour chart. But I understand your frustration. The other choice is to, instead of trading forex markets, trade actual futures contracts, and then the prices are reliable. So if you trade the actual euro currency futures contract, I'm trying to pull it up. I don't even know if I have it on this computer. I have it on my other computer. It's constructed the way any other chart is constructed. This is a 5-minute chart of the euro currency futures contract. And if you look at it, and you bought with stops above bull bars, it's a pretty reasonable thing to do. And you'll get one tick. You're buying one tick above a bar, you're selling one tick below a bar. And for the most part, you're not going to get much slippage. The bars have bigger volume today because of the reversal. Currency markets reversed as well. But if you have access to futures contracts, that is an alternative, and they're very reliable. It's not like Bitcoin where you get crazy slippage. Here it's very accurate. It's heavily arbitraged against forex markets. All right, I've talked too long. A pretty climactic day. A good buy signal bar on the daily chart. Bulls are hoping that this is going to be a V bottom and that we'll just rally relentlessly. And for the bears, I think it's over for the bears. We had very good reversal here and again here, and now we're getting a second good reversal. I think if we go lower, we're not going to get much below 4,000, 3,800 or so. So only 2 or 3% below today's low, and that means I think we're either going to be sideways or up. And since we've been in a trading range for 7 months and we're reversing up at the bottom, we're probably going to go higher. Probably up here at some point in the next few weeks. So it looks like sideways to up. And the bulls who did not buy today are looking to buy maybe a test of that low. So there'll probably be buyers somewhere in the middle of today's range. On the 5-minute chart, it's a climactic day today. So 75% chance tomorrow we'll have at least a couple hours of sideways to down trading. What happens if we gap up tomorrow? We might. The context is really good for the bulls. But here's the 60-minute chart, big tail on top, very tight bear channel. We're probably going to have to get some kind of a test down to a higher low major trend reversal on the 60-minute chart. I doubt we're going to go straight up. But I do think that on the daily chart, it's telling us that we're probably going to have a hard time going much below today's low. All right. Hope everybody has a good night.